What is up, everyone? Today, I got something really cool. If you guys know me at all, you're probably watching and maybe following along on Twitter. We do these weekly stock picking kind of tournaments or competitions with Wolf every week. And a lot of times you'll see me actually pick these leverage ETFs. And in real life, the true story is I actually trade these all the time. But today we have a special guest. I'm going to talk a little bit about my experience too, but I wanted to bring him in. His name's Will Rhind. He's the CEO of Granite Shares, and he runs some of the best leverage ETFs. And I mean, he has a whole litany of products. But Will, if you're there, just give me a wave if you're ready, and we'll bring you on. There he is. Will, what's going on, man? How are you?
Great. How you doing, Jason? Thanks for having me.
Very good. Yeah, appreciate you coming in. So, if anybody's not familiar with this, Will Rhind is CEO of a company called Granite Shares, and there are very few good ETF companies out there in my mind. And Granite Shares happens to be one of my favorite ones. But Will, if you want to give us a quick overview of what Granite Share does, maybe like what differentiates you guys from some of the other options that are out there, because there are a few. But in your words, can you give us a little breakdown of the journey and where you guys are today?
Yeah, no, sure. Happy to. So we are a ETF company. That means we just specialize in ETFs. The only thing we do is create ETFs. We list them on the stock market so that people can trade them. We don't do mutual funds or any other products other than ETFs. And all of our ETFs kind of fall under what we refer to as high conviction sort of offering, which means that whether you're talking about something as simple as gold or whether you're talking about 2x NVIDIA, they're all high conviction investments. And that's really what sets us apart from some of the bigger firms that you may be more familiar with, where it tends to be more generic, sort of buy and hold type products. So when you think of us, think of high conviction investing, think of differentiated products, typically things that are unique in the market that you're only going to find from Granite Shares. And one of the things, which I'm sure we'll get into today, that most people know us for is the leveraged single stock ETF offering, right, which kind of, as it sounds, is just leverage on individual stocks in an ETF.
What made you guys go into that arena, right? I think, most people think of ETFs in general as kind of like the baskets of stocks, but you guys made a decision to launch this leveraged single stock ETF product and multiple products, right? If I'm going to jump out a limb here and assume that NVDL could be one of the largest ones in the bucket, but it's almost like the Mag 7. So you guys have Tesla leveraged long and short 2x, AMD leveraged 2x, you got Amazon, Microsoft, Apple, Coinbase. If people didn't know, there's a Coinbase leverage 2x ETF. So, for me as a trader, I love these things. Your entry price is low, but, they're really good for people that don't necessarily trade options, in my opinion, or maybe can't, right? NVDL, I'm going to assume, again, is probably the largest one or probably the most active.
It is, yep.
But so many different, and you guys even have BABA, right? So BABA,
right, yeah.
ETFs, nobody has, very, very few have these. So can you kind of walk us through what was the mindset when you guys launched this product, and who is the investor that you were targeting for, and maybe where do you see it going from here?
Yeah, so at very high level, leveraged ETFs are nothing new. They've been around for well over 10 years, super popular. But most people are probably familiar with the fact that most of them are broad equity indexes or broad fixed income indexes, right, which obviously there are certain equity indices like the Qs or particular sectors that people love to trade, especially with leverage.
Yep.
But the majority of those equity indices are probably not too interesting for people. And we thought about, well, hang on a minute, like the more sort of intuitive application of leverage is actually on individual stocks, where people use a margin account typically and use leverage, whether it's in the form of traditional margin accounts or options trading on individual companies. And actually that wasn't the thing that was, that didn't exist in the market. So we started to do this in Europe a few years ago. And the reason was because at the time, the regulation in the US was as such that we couldn't do it here. And so once we started doing that in Europe, we gained experience on what stocks people liked and what people really wanted to trade and own. And then we were able to bring some of that experience here and launch the current offering that you see. So yes, a lot of it, surprise, surprise, is in those mega tech names, and that's just because that's where the action is. Put very simply, that has been the trade of the last few years. Those companies are really where all the attention has been. It's not to say that there's not going to be demand for things that are not tech, but at least the big stories, the big names, all really exist in that sort of FANG/Magnificent Seven category.
You guys did jump out on a limb and opened the Coinbase one as well. What was the thought process behind maybe like spearing off into a different direction? Not that Coinbase isn't tech, but what was the thought process behind something like a CONL ticker? So that CONL, by the way, is a 2x leveraged long Coinbase ETF, and single stock leverage ETF again. It's just amazing to be able to see this type of options or optionality in terms of equity trading. But what was the thought process behind something like that?
Yeah, so with that one in particular, at the time we did it, we saw the landscape and thought there was a big opportunity for 2x Coinbase. And the reason was there were no crypto or certainly no Bitcoin ETFs at the time. There were no leveraged Bitcoin ETFs. So
still
as
no
you probably are aware,
Bitcoin ETFs.
There's like tons of interest in the whole Bitcoin ETF story. And the media is talking about it, the Grayscale at the Times in a fight with the SEC about denying, a Bitcoin ETF. And, all of this has just sort of been constantly played out. So we thought, hang on a minute, there must be a way to give people exposure to crypto, but do that in a way that we can, have it on our platform. And so Coinbase was the biggest, or is the biggest, stock in the crypto universe, and kind of the poster child, and incredibly correlated to Bitcoin anyway. And so that was a way that we were able to, offer a proxy investment to people to get a leveraged exposure to crypto. And clearly, at the end of last year, when all the hype was particularly building around the launch of the Bitcoin ETFs, I mean, the returns on CONL were just absolutely crazy.
I mean, I could look back on a NVDL chart too, and we're like, hey, can we see the future? Who knows? But that's one use case, I guess, is kind of leveraging that short-term momentum. As the CEO or the guy that runs Granite Shares, where are you seeing most of your customers' use case here, and how do you see people using these single stock leverage ETFs the most?
One of the most interesting things that people perhaps don't necessarily realize is that we don't actually ever really see the customer directly. And the reason for that is because we manage the fund, like we create the fund, we manage it, we list it on the stock exchange, but we're effectively disintermediated by the stock exchange. So in between us and then the end investor, there's a stock exchange and a broker. And so it's the broker that really sees the actual trades that we don't. So what I would say to you, just from doing this for a long, long time, 25 plus years now, is that it's a spectrum of buyers. So there's not just one customer, or stereotypically one customer that uses our product. You've got anybody from, let's say, retail traders up to the most sophisticated, hedge funds and proprietary trading firms in the world, and kind of everything in between. So it's really, when you have a fund like NVDL, it's $2 billion, so $2 billion worth of investable capital. That's a huge amount of people trading it. And as we've talked about sometimes on, Wolf Show, on X, etc., that's people all around the world as well. It's not just people here in the US, because a lot of these stocks, if not all of these stocks, they're global phenomenons. They're not just US phenomenons. So there is no other company like NVIDIA, and that only exists here. So if you're in Taiwan,
there is no other company like NVIDIA. True
that's
story.
It. You come to the US market to get that, and you come to Granite Shares to get that.
Also, the fact that you guys have the short ETFs as well, right? So single stock leverage short ETFs. As a trader, I can look at this quickly and say, hey, look, there's an opportunity. Maybe I'm long an equity underlying, and I'm maybe cautious about it, and I don't want to sell upside call premium, and I don't necessarily want to take the risk on downside put premium if it doesn't happen. Or maybe there are instances where downside premiums or put premiums are extremely elevated. As an options trader, we see that all the time, and you can just quickly look at it and say, hey, look, the risk is not worth the reward. But again, you guys have both these inverse. So short NVD is your ticker for the short ETF, 2x leverage short. I know that we've had some conversation in the past, whether it's an ETF or an ETN, think other things. But what have you guys been seeing on the regulatory front in terms of these type of leverage ETFs? Do we have any insight on, like, is it maybe going, are the limits changing, or what's that landscape been looking like lately? And what do you think, as a CEO, what do you see coming in the near future?
First thing I'll say is these things take a long, long time for any sort of major change to happen. So there was a period of time where I kind of alluded to it when we were talking earlier, when I launched or started Granite Shares. That was 7 years ago. And 7 years ago, you couldn't launch a leveraged ETF. And there were only 2 companies in the US that could do that. And there was, again, a historical regulatory reason why that was the case. So we had a harmonization of the rules a few years ago, but those rules had effectively been in place for the best part of, let's call it, 20 years. So it's not to say that there couldn't be any change, but I think it's very unlikely we'll see any change to like the leverage limits kind of anytime soon. So I think 2x is our cap, for the foreseeable future. It might change at some point, but most likely at a very minimum would have to be a different administration that in place before we could see that.
Got it. You guys have been pumping these out at the same time at 2x leverage, single stock. How many tickers do you have now?
We've got 13. So the 13 of which 3 of those are short, and 2 are 2x short. 1 is just 1x short. So there's no leverage, and the rest are all long. So the market naturally skews long, but we do offer, or try and offer, shorts where there's just a big interest in both the long and the short side. So Tesla, for example, and NVIDIA. And for those that think, well, there can't be any short interest in NVIDIA, it's more, I would say, tactical, in the sense that a lot of people are long the stock and have built up a lot of gains, capital gains, embedded capital gains. They don't necessarily want to sell the stock and realize those gains, but at the same time, there are going to be periods when, the stock might have overshot to the upside, or people just want to try and, generate some capital losses, etc. So there are ways to tactically use a short product that still enable you to trade around the stock, but you don't touch your underlying position that you have, for the long run.
When you guys were the single stock leverage ETFs, was that the first product that you guys launched with, or was that later down the road?
It was later on down the road, because when we first started the company, we couldn't do leveraged funds, any kind of leveraged fund. So we actually started with our broad commodity ETF, which is COMB is the ticker, COMB. That's like, think of it as like the SPY of commodities, or the Q of commodities. Right. So that's just a basket of the most liquid, most traded commodities in the world. And for people that want to just say, hey, I need commodities in my portfolio, I don't know whether oil is going to outperform gas or whether wheat's going to outperform corn. That's the sort of the buy sort of default impulse that people typically use. And so that's the first one we launched. Then we launched gold, which is our BAR, B-A-R is the ticker. The physical gold just tracks the price of gold up and down, but backed by physical bars of gold that sit in a vault. And so I haven't actually read the story, but I saw a headline today that Michael Burry's just, I guess people have dug into his latest 13F or something and seen that gold is now his top holding.
They are coming out with those right now, yeah.
Exactly. And then we launched platinum, which is again the same thing as gold, just a much rarer metal, 30 times rarer than gold, smaller market, has both the jewelry aspect that gold has, but also the industrial aspect that gold doesn't have. And then from there, we went into the equity space, the income space, and then single stocks. We only launched the first single stocks about 2 years ago. So it was like the summer of 2022, really, when we first launched those.
So who do you guys when you come up with these products, what kind of investor or trader do you really have in mind right now? And who would you say, in your words, are these products really geared for?
I think the core has to be active investors, active traders. I mean, again, we like the words high conviction. So it's like high conviction based investors And typically the one thing that I would say that you have in common if you're a high conviction investor is like you're somebody that has a passion for markets. And typically you're looking at your portfolio, on a very regular basis, if not every day. So it doesn't mean, that you get pigeonholed as saying it's for day traders. It doesn't have to be for day trading. It's just for people that are very active, love to take a bit of risk and monitor their portfolio on a daily basis.
That makes perfect sense, right? When people start looking at these, they get concerned maybe with risk and things like that, and maybe not understanding fully how they actually work. And while we have you, I'd actually take the opportunity to, if you could give us like a quick overview of how does Granite Shares actually like manage the ETFs, and how does Granite Shares manage the risk around these type of ETFs, and what does that really look like for someone that might be interested in maybe dabbling in some of these?
No, absolutely. So it's interesting because we, in a way that these are trading products, but yet we as a firm get compensated as a non-trading product, like a traditional asset management. So we make a management fee, which we charge on the product, which, every day generates a small amount of management fees, but we don't make any money from the trading of it because it has nothing to do with us. We don't make any money elsewhere on the product in terms of sales commissions or anything. It's just the assets. And the way the product works is that we get leverage from broker dealers or from investment banks, and we get that in the form of derivative contracts, which effectively mean that you're getting the financing from that broker dealer or investment bank that allows you to have the leverage position in the fund. So the idea for each of these, whether it's long or short, is to meet an investment objective, which is typically 2 times. So let's say it's 2 times NVIDIA. So the fund is trying to match a 2 times performance of NVIDIA over that given day. So
And it's a daily inverse, right? And so again, for someone who's not familiar with this, I know you mentioned, management fee. I actually happen to know that you guys are very, very low on that from that perspective. If you could give us what was that percentage again? It was,
so it's 99 basis points per annum. So if you contrast that to, a margin account, you might be charged 12 to 15%, something like that. And remember, if you hold it for one day, it's 1/365th of that. So it's a fraction of a basis point, or a fraction of 1/100th of 1% per day, which is basically nothing.
Yeah, absolutely nothing. People get kind of tied up in thinking, hey, maybe there's like this, we call it decay, but I think it's what it really is. It's the way that the ETFs work, right?
That's right.
It's a daily compounding. So, I mean, as the fund manager, could you give us, how does it work when you're managing that compounding effect over time, and what does the fund do to keep, I mean, how could you possibly keep track this well, 2x leverage every day? It's pretty amazing just to think about how, I mean, the mechanics of how that would even work.
Yeah, so very simply, the way that works is another way to think of it, and what some people call the ETFs are constant leveraged ETFs. And the constant's the key part, because to maintain 2 times leverage every day, that means you have to rebalance the portfolio at the end of each day to make sure at the beginning of the next trading day, you're hedged and you have 2 times exposure. So if you didn't do that, then your leverage amount would just naturally drift.
Right.
And that's no different to what happens if you had a margin account. But the way the broker compensates for that is by adjusting your collateral. And so if the position's going against you, the broker's going to demand more collateral for you to true up, and then obviously vice versa. Because the ETF doesn't do that, in other words, there's no margin needed on behalf of the investor, it's all built into the product, the reset or the rebalance happens at the end of each day. That way, every trading day, yeah, exactly, on our end, you get 2 times. And what that means from a performance perspective is it's a non-linear return. So every day, you have 2x at the start of each trading day. It's 2x on the back of the performance from the previous day plus the reinvested profits. So you have a compounding effect that doesn't exist if you just have a linear return. And so to try and put it as simply as possible, if you have a market that's trending, in the 2x levered product will almost certainly outperform the linear return of just the underlying, say, 2x, whatever the performance is over that given time period of the stock. Obviously, the opposite way is also true, because you levered, you'll underperform on the downside. And then really the environment that people need to understand and be aware of is a market environment where there's no trend at all, and it just is very choppy. In other words, the stock or the market's going up and down every day. That's the sort of the worst environment for these products, because that's when the decay, if you will, hits in. And the decay has nothing to do with fees. It's about how the rebalancing affects the NAV or the performance when you go up and down, up and down, up and down.
And I think that is exactly where people kind of get hung up, right? So, I mean, as a trader, we could say, hey, you know, probably try to stay away, but it has nothing to do with fees or anything like that. It's just like you say, in the rebalancing, right? You know, and actually there have been some income ETFs. I know there's Granite Shares. I'm kind of like poking here, seeing what's on the future, right? Like we've been here, we've got a good overview, I think, of specifically the single stock leverage ETF. So I definitely wanted to get out, because I think that just a huge demand for that. I hope that you guys have some tickers coming down the road. Maybe we've talked in the past about some possible additions to the Granite Shares family. I don't know if you want to give anybody a sneak peek on that, but yeah, I mean, what do you guys see coming down the road, and what's next for Granite Shares? Where do we see you guys going?
Yeah, I think we like the income space. I mean, we have an income ETF at the moment called HIPS, which is a unique strategy, and the HIPS stands for High Income Pass-Through Securities. So it's about a 10 to 11% per annum yielder at the moment, and that comes from, it's not leveraged, it's just a regular ETF income strategy, but that comes from pass-through securities, which are kind of interesting section of the market, and these are all securities that don't pay corporation tax. So examples would be things like MLPs or master limited partnerships, which are typically oil and gas pipeline infrastructure, or REITs, you know, real estate investment trusts. It's all securities that by law have to distribute almost all of their income. So MLPs, REITs, BDCs, or business development companies and closed-end funds. So we like it. We've liked income. We've liked that for a long time. We think that in a market where interest rates are coming down, or at least forecast to come down, that having high income will be again super popular, come back into vogue. So we want to do more in the income space. And then on the sort of the broad equity space, we have our DRUP strategy, which we've talked about before, which is
this is one of the favorite ones. So
yeah, like an alternative.
When I first ran into this DRUP ETF, I took one quick look at this and I was like, what? I was like, what's happening right now? But yeah, if you want to give them a quick overview, if we have a couple minutes, I think that would be so. Sure. By the way, if you haven't already, just go, it's graniteshares.com. You'll see a whole list of the ETFs of the products. When Will says high conviction, I mean, this was part of one of my things that I kind of fell in love with the company, was like, you know, anything that they list, I feel pretty confident, like, hey, this is going to be good stuff. And one of those little gems, you know, inside of this giant list of ETFs was this ticker, DRUPT, right? And I, you know, standing for the NASDAQ disruptors. But somehow Will has found a way to like systematically put, I mean, actually here, you could pick it up from here, Will, before I become like the fanboy, but give us a quick overview of what that DRUPT ticker is.
Yeah, so it's the 50 top disruptive companies in the US measured by NASDAQ. So I like to joke that we worked with NASDAQ obviously extensively to build this product. And if they were designing the Qs today or redesigning the Qs, then DRUP would be kind of the answer that would be presented to the market.
The redesign. So,
this is like the little known. If you had the rethink of what the Qs are, I'd like to think that DRUP would be that expression. Yeah. So the performance has been amazing. It's a more concentrated portfolio, and you know, think of another way that it's like you know, a Cathie Wood's ARC, but more sustainable.
I don't think this is comparable. Well, this is on a whole nother level. Sorry.
Yeah, no.
Like this is a whole nother level.
I agree. But this is the rethink, right? So it's the rethink of innovation investing and not just investing in companies that are growing, but have no profitability or no chance of turning a profit. This is not about pursuing growth at all costs. This is about innovation investing, but with a quality tilt to make sure that, again, it's a rethink on what's happened over the last few years to make sure that, yeah, we want growth. We want amazing disruptive companies, whether they be in the technology space, whether in the healthcare space or others. But we want those companies to be quality as well.
Right.
And we want those companies to have moats around them that are defensible.
You guys have measurements for defining that quality, right? Like if you want, can you give us a quick, since we're on it, I mean,
we've got six factors which we've isolated that are signals that have been, again, heavily researched and tested, which screen the companies. That's how we take the universe of 500 companies and then screen them all, and the top 50 get selected. So one of those would be the size and the value of a patent portfolio. So typically we find that disruptive, great companies have valuable patent portfolios, not big patent portfolios and valuable. And that kind of makes sense when you think about it, that the reason why they have a moat or such a strategic advantage in whatever sector or industry they're doing is typically because it's almost an unfair advantage, and you get that by inventing or designing a technology which you then patent, which nobody else can use. So we typically find that those companies score very highly, and NASDAQ owns one of these companies that their whole job is evaluating the value of companies' patent portfolios. So that's a proprietary thing, and again, you won't see that in other ETFs. We then use some traditional metrics like how much research and development, R&D spending the company's doing, how much profit they're making, etc. And so that's the quality tilt that goes alongside, highly disruptive behavior. That means that you're getting innovation, you're getting access to the top 50, innovation names, but there's a quality tilt to make sure it's not just garbage that, are here today and then gone tomorrow.
No, I like this too. And I can just look at the fund. I have it on another screen here, but it's not unlike some other ETFs. It's not completely focused in IT. I can look at it today and it's got like 22%, a little over 22% in healthcare, right? And I can look down the list and on the top 10, Danaher, right? You wouldn't have necessarily thought that that's, something that's going to be in a disruptor. But like you said, based on the patents and the value of everything they do, I mean, it is huge, right? You also have Alphabet, Meta, Microsoft, but you have things like Qualcomm, right? Broadcom, Salesforce, even Johnson and Johnson, but like it's a very diversified fund. And I don't know, maybe how often does this rebalance itself? So you had mentioned
once a quarter.
So once a quarter. If an investor owns something like ARK, we know that they're trading in and out of things seemingly daily, right? And so
they've missed everything this year. So they're down 20+%.
Right.
And
where maybe they sell something at the lows and then it happens to be something good, NVIDIA, cough, right? But like there's always something like this. So this way we know, hey, look, it's rebalanced quarterly. Like you're saying, it's not single focus. These are large cap companies. They're not, and it's different in that regard too, right? These are not small baby companies. These are all large cap companies, completely vetted.
They have real profits, real businesses, and like I said, they're disrupting in their particular vertical, whatever it may be. And I firmly believe, I think we've talked about this before in the past, that some of these healthcare companies are going to be really the companies we're talking a lot about in the next 5 to 10 years, because these are the companies that are going to be able to use AI on their own research, all the drug research they've done over the last 2 decades is proprietary to them. That's not, out on the internet. And they're going to be able to use AI on the proprietary research that they've done to make these discoveries that perhaps were lying in plain sight, but nobody could find. And that's going to lead to some big breakthroughs that will accrue to those companies because they have the data and they can use AI to take advantage of that data.
Yeah, no, I love it. Appreciate your time, man. I think we've gone through a lot of this stuff. Everything you guys have has been just absolutely amazing, like of a find. So if you don't know, again, it's graniteshares.com. check out the list of ETFs they have. It's not just the single stock leverage. I mean, we know that they're one of the most liquid single stock leverage ETFs out there. So again, if you are an active trader, this is definitely where you want to land. I mean, you guys have, if you didn't know, Coinbase, single stock leverage, Amazon, AMD, Meta, which is under FBL, right? Is 2x leverage. Meta, I mean, geez, the list goes on, but all the way down to Baba and a handful of other. Looks like, there's not a lot of turnover in some of these other type of funds. So again, per Will's words, high conviction across the board.
Yeah, the levered ones, you're going to get way more turnover. I mean, we're doing somewhere in the region of $700 to $1 billion a day in volume on our platform. So it's crazy on a day like today as well. I mean, you look at the volume in NVDL, look at the volume in Connell, and admittedly, we've touched all-time highs on the S&P, all-time highs on the Nasdaq. The meme stocks are on the tear. So it's a good day to be in the long levered ETF business.
They delisted. What was that? The meme stock ETF. That's gone now.
That's gone. Yeah.
Might
be
probably
racing to get it back right now.
I believe it. So cool.
Yeah.
All right. Well, I appreciate you, man. It's been amazing.
Great to talk to you.
Yeah, and I'll see you out there.
Yeah, exactly. Look forward to it.
All right, guys. I'll see you.
Take care.